So I'll now move on to something substantial and sensible. The Chief Executive and Group Chief Financial Officer update. And I would introduce Mr. Stebick and Mr. Gudsall to make their reports, plus various associated troops.
Oh, sorry, Mayor. I just wanted my vote recorded against the previous item, against A.
It's been recorded.
Thank you, in terms of not receiving her report. Supporting it.
Okay, thank you, Mayor Brown. Good morning, councillors. This morning we have a big agenda for the governing body, and a number of the things on the governing body agenda will be helpful in terms of understanding recent performance. I'll not cover things that I know are elsewhere in the agenda, but I will make some comments. Firstly, in relation to the flood and cyclone recovery effort. As I say, there will be an update on this later in the agenda. We've now moved, of course, from the national state of emergency having ended, transitioning the work from that emergency response to recovery. We've appointed Phil Wilson as the interim group recovery manager as we progress with the recruitment for the recovery role. The Auckland Recovery Project Office is established with a small group of core staff supported by a larger group of seconded staff from across the organisation. The governing body, as I say, will receive monthly progress reports and updates on the January flood and Cyclone Gabrielle recovery program. An initial one of outlining the transition from response to recovery is on the agenda for today. I want to comment on delivering on our annual plan cost reduction and budget commitments. It's obviously a priority, and make a couple of points in relation to my key objectives in support of that commitment. One of which is to meet or exceed the operating expenditure savings target of 90 million. Without the permanent savings made since 2020, I would observe that general rates would have needed to have been at least 3% higher. The savings have been made through operational efficiencies like fleet management, office space reductions, procurement savings through contract negotiation or renegotiation, service delivery improvements like the continuing digitisation of services, and there's been no growth in support areas like HR, finance or governance. We've achieved a total of 76.3 million of cost savings to the end of February 2023, with a further 3.5 million in the process of being delivered. Examples of work in delivery include ongoing savings programs through better procurement, especially as it relates to software and systems, ongoing workforce and work program reviews, and we're reviewing any vacancies arising from resignations as part of our standard practice now in preparation for the FY24 annual plan. We are comprehensively reviewing all current vacancies, and we expect to realise another $2 million from the removal of vacant positions across a range of directorates in the organisation. The challenge, of course, is to achieve enduring savings and cost reductions. Of the achieved 76 million so far, approximately 60 million of that is enduring, that is recurring year on year. On top of the existing controls and protocols that are a part of our financial and workforce policy, additional financial controls were also put in place in February. There are some risks. Savings are becoming harder and harder to achieve, of course, and we need to divert some of those savings in support of our recovery effort. A second objective I want to comment on is keeping within staff budgeted costs of 633 million. Employee benefits, including our contributions to KiwiSaver, ACC and staff salary costs, our employee benefits year-to-date actual costs are 399 million against a year-to-date budget of 409. That's a 2% positive variance. The 10 million lower than budget is mainly from staff vacancies that we're holding as a result of slowing recruitment and the tight labour market, which is impacting our ability to recruit frontline and priority areas. Technical roles in ICT and regulatory in particular have been most impacted, as these are the areas where the labour market is active and most competitive. and there's some pressure in frontline roles as well for customer and community services activity. The attrition rate in the organisation is slowing. So the annualised voluntary turnover rate for permanent employees is 15.8% at the end of Q2. Earlier in the financial year, it was materially higher than that. We've seen no movement when compared to Q1. However, the rolling quarter attrition as at the end of Q2 is 2.9%, which is a decline since the end of Q1 at 3.7%. I want to make a couple of comments in relation to engagement. Staff engagement has trended down from 7.7 to 7.4 since the last survey was undertaken in November. People are, of course, continuing to say that council is a great place to work, but the current environment is creating challenges with budget cuts, increased workloads, and a sense from all of that of some reduced level of job security. Many comments relate to indicate anxiety around restructures that wouldn't recommend Auckland Council under with some level of instability and uncertainty that arises from the conversations that we've been inevitably required, have been necessary to have. There is some pressure in the workforce. Of course, we are asking our workforce to maintain all of the services that we always maintain, but also respond to the recovery efforts, and we're doing that largely on a seconded basis. So people are stepping up to increasing pressure and increasing demand, and I'm very thankful to our people for that. I want to hand over to Peter now to talk about the financial performance.
Thank you, Jim. And next to me I have Gary Blick, Chief Economist, who will make some comments at the end around economic outlook. Our next agenda item, item 8, has fulsome reports and presentations on performance to December and also our interim results to the end of February. So I'll keep my comments here reasonably brief. Results for the Auckland Council Group for the 8 months ending 28 February 2023. On the capital investment side, there was $1,614 million of expenditure against a budget of $1,750 million. Highlights of the last 8 months include the start of design and procurement to reconfigure Custom Street to Shortland Street to align with the design elements of the recently completed Shortland Street to Merrill Drive section. Omaha and Onehunga Captain Springs Road stormwater management projects were completed to prevent flooding, groundwater contamination and sewage outfall. And for the Central Interceptor project, the tunnel boring machine has now completed the crossing of the Manukau Harbour and reached the shaft at Pump Station 23 in Hillsborough and continued to Keith Hay Park. Direct revenue was practically on budget, $1,736 million against a budget of $1,713 million. There were a number of unders and overs within this, of course, with the largest being a $44 million under on public transport, parking and infringement revenue, $36 million under on water care infrastructure growth charges and new connections revenue, an upside of $21 million on water and wastewater charges, an upside of $25 million on port storage and demurrage, $14 million upside on Auckland Transport Waka Kotahi operating subsidies, and $13 million upside on Tataki Auckland unlimited fees, user charges and operating subsidies for Project Activate. On the operating expenditure, our direct operating expenditure was $2,238 million against a budget of $2,559 million. That's lower by 1%, and this is mainly due to an under on $10 million of employee benefits and $9 million under on repairs and maintenance. The other key aspect I'd like to bring to your attention is net debt, a year-to-date increase of $388 million, which takes our net debt to $11.5 billion, which is well below the year-end budget of $12 billion. If we now look at Auckland Council within the group, the results for Auckland Council for the 8 months ended 28 February 2023, capital expenditure was $256 million. That was an underspend of $71 million. Direct revenue was on budget, $373 million against a budget of $370. Direct operating expenditure was 964 million against a budget of 1,013, which is 49 million below budget, reflecting the trends I was talking to earlier. And in terms of the savings target of 90 million, as at the end of February, we were at 76.3 million, so well on track towards that 90 million. Now, there are probably, although these are probably not of interest, there are some accounting considerations of storm costs, which I thought I might bring to your attention. And this is around the costs that have to be taken onto the profit and loss and how we account for any insurable receivables. Effectively, as entities start spending on the insurable clean-up costs throughout the group, the repairs and asset renewals, the group will start incurring that expenditure. However, to the extent that there is any applicable insurance receivable, this will not be shown until such time as a claim is formally accepted by the insurer and the payment is forthcoming. So unless that revenue is reasonably certain of being received, we can't actually account for it. There are various scenarios within our storm aspects. The revalued asset might be damaged, the asset held at cost is damaged, and the clean-up costs, which have to be taken through as OPEX. With respect to the annual budget, that closes on the 28th of March, which is approaching fast. We have over 10,000 submissions, but we are still seeking more. So if there is the opportunity to encourage more submissions, please take that opportunity. The last item for me is the key economic market activity that has been provided in the report. So the key dynamics across the inflation rates, unemployment rates, gross domestic product, Auckland new dwellings and OCR are all included in the report. But I'll pass to the Chief Economist now for some brief points on the economic outlook.
Good morning and kia ora koutou. Thank you, Peter. Some brief comments on the economic outlook, if I may. Firstly, I'm sure many of you will be aware, consumer price inflation is expected to remain elevated this year, although easing from the 30-year high of 7.2%, the Reserve Bank forecasting 5.3% by the end of the year. And that's being brought about through increases to the official cash rate, which are expected to gradually dampen demand. As households and businesses face those higher interest rates on their debt, they'll adjust their spending and investment plans accordingly. The Reserve Bank did update its forecast in late February, signalling a peak in the official cash rate around 5.5% by mid-2023, and that's not materially different to what they've been forecasting or implying in late 2022. The next decision's on the 5th of April, and it'll probably have to take account, or will take account of, the latest GDP data for the final quarter of 2022, which was much softer than expected, showing a contraction of 0.6%. Instead of a modest increase. And so that may mean that activity had started to contract earlier than expected late last year. And so that's a softer starting position when they think about the forward path for the OCR. But I guess balancing that, we get to see material signs of inflationary pressures abating and yet to see signs of labour market tightness softening either. And the full impacts of the severe weather events in terms of the pressures on the construction sector are yet to materialise. I just note from a household perspective, households will of course continue to face those increases in the cost of living, particularly through food and transport, household services and utilities, as well as for those that are indebted, higher debt servicing costs on their mortgages, although it's an increase off record low interest rates. While some households have had strong income growth, and I'd note that benefits and superannuation payments will be adjusted to match inflation on the 1st of April. We would expect the cost of living increases and those higher mortgage rates, and in the context of lower house prices, mean that we'll see a sustained slowing in household spending through this year as households feel those pressures and those that are indebted direct more of their income towards servicing their debt. Finally, I'd just like to comment on the impact of the severe weather events. I noted last time that our asset base has been damaged, and while we may see heightened economic activity to repair that asset base, we shouldn't lose sight of the fact that what's really going on is a reprioritisation of our resources to repair that damage, both on the infrastructure side and on the privately owned side in terms of buildings, particularly dwellings. And that comes, of course, with an opportunity cost because The benefits of, or the projects that need to be deferred in terms of infrastructure, we won't see those benefits because we're having to reprioritise. And similarly, on the residential side, constraints in funding, constraints in the construction sector mean that more activity will be diverted into repairs, and so we would expect a slowing in the rate of new builds in terms of houses. I'd probably just conclude by saying that much of what I've said is about the near-term challenges, particularly around the economic cycle. We shouldn't lose sight of the fact that Auckland has some long-run competitive advantages that are still intact, and many of those are from our advantages of scale around our ability to attract skills, offer employment from higher income, offer employment and higher incomes, amenities, consumption possibilities, and the like. So just offering a view there on the medium-term outlook. Thank you.
Thank you, Gary. We also have on screen slide 2 from the next agenda item, which provides the financial and operational context under which the organisation has been operating over the last 3 to 4 months, which I'm sure everyone is aware of. But when you see it in a chart like that, it's quite stark what has been going on in the finance and operational spheres. And I'll pass back to you, Your Worship.
Thank you for that. There was a lot of ups and downs in your analysis there, and we're going to question everybody to make sure they got them. I don't think they did. It was like a fiddler's elbow, but the overall thing is gloomy. And in terms of, from the economist, you've missed out the fact that we have the record lowest house sales activities for many years and the record high external deficit. And it's very gloomy, and if you speak to the debt recovery sector, they'll find that people are extending without negotiation, and there is a lot of damage out there at the moment, particularly in lower socioeconomic areas. So it's grim. I think you've probably got that, but just in case anyone felt that it wasn't grim, it is. And I think at one of our next meetings I might get one of the practitioners in the debt servicing field in to have a chat, just to make sure that everyone gets what it is on people with small debt as well. Quite tricky. However, the overall theme from the Chief Executive and the Chief Financial is that they are continuing to apply pressure to our costs, and for that I thank them. So a mover and a seconder to receive the FIFIDs. Me and Deputy. All those in favour, please say aye. Contrary, against, we can take questions. Ken Turner's got his hand up.
Sorry, thank you, Mr. Mayor.
Wayne Walker.
I'm sure I heard you say something about an increase of debt of 300 and something million. On the 3rd of March, you got a memo from you, sir, Mr. Gutzel, which says net debt, a year-to-date increase of 587 million to 11.7 billion.
I believe the 588 would be to the end of December, and that would be gross debt rather than net debt, and we would have to take off current borrowings and cash equivalents to get to the figure that I quoted. However, you may be looking at December rather than February as well. So the figure I just quoted was the end to February, and item 8 has the breakdown of the net borrowings increase to net debt.
It says here January performance report, but okay, thank you very much.
Walker, then Darby.
Sure, I've just got a question around access to better financial data. That reflects the letters of expectation, particularly to the council-controlled organisations, where we, as councillors and the Chief Executive, have sought access to the financial data at a granular level from Auckland Council, which I understand we now have to a degree. So how are we getting on with access to the granular financial data from the CCOs, both as it goes to recent history, and we're looking for some years back, and as it goes to going forward? And further to that, just noting that there's been a substantial increase in the expenditure on the part of certainly the council-controlled organisations, even factoring out inflation and taking into account, frankly, I would suggest little increase in activity if you compare 2023 with 2021, because 2022 year was an anomaly because of COVID. So I'd just invite a response to that in terms of how we're getting on, given the urgency.
Councillor, thank you. Firstly, maybe with respect to the provision of information, as you note, I think we've made progress on that subject for the council parent. We've had just today a very constructive conversation with the chief executives of each of the CCOs. We've provided to them the framework under which we council parent, provided that information, and each of the CCOs has undertaken to use the same framework, and with the urgency that you've articulated, to provide that level of detail as quickly as possible. We expect to be able to do something imminently in a week or two. So that was a conversation this morning. We're going to continue to work towards that. I'm looking to Peter to see whether he wants to add anything to it. But as I say, good cooperation on that conversation this morning.
Just a further question to that. Any prospect of anything earlier than a week or two? Because there is some urgency on our part because of the budget process that's underway, and we can deal with the analytics with some support from officers. We just want the data. Thank you.
We are. They understand the urgency, councillor, and it could be shorter than a week or two. It could be within the next week. I just don't want to make a promise on their behalf.
Thank you very much.
Good response. Thank you very much for that. Councillor Darby, please, and then Councillor Butt.
Thanks, Mayor. Gary, Federal Reserve has just announced a 25 basis points increase. Probably a month ago, they were talking, there was forecasters, economists like yourself were talking probably about 50 basis points. There's an easing there. Of course, that's their market, not our market, but our market is influenced by theirs. What are economists seeing as the profile for inflation going forward for New Zealand?
Well, there's a range of forecasts. We're currently at 7.2, and I guess the credible or major forecasts have us all reducing over this year to somewhere between 5.1 to 6.4. So there's differences over the speed of that decline. I guess new data, as I mentioned, the final quarter of 2022, GDP looks a bit softer, materially softer than expected. So the starting point of activity is lower than previously thought. On the other hand, we're yet to see indications of inflation abating in terms of any leading indicators, and similarly on the employment side, the labour market is still very tight. And I guess in terms of upside risk and around the duration of that profile of the peak of our inflationary pressures, we yet to see the full extent of the impacts of the recovery from the severe weather events in terms of the pressures that places on resources. So a balance of, I guess, risks there.
So just when it comes to debt servicing, you're saying some of the, the averaging of the economists' forecasting is showing a little bit of easing, likely? Is that what you're suggesting?
Oh, well, what I would say is that relative to views that were emerging late last year, what we're seeing now is not materially different. So the profile that was forecast by the Reserve Bank of the OCR being raised to 5.5 around the middle of this year, it's probably still, something like that, or perhaps a little bit lower. There's some picking around 5.25 as the peak rather than 5.5 for that OCR level.
Good question, good answer. Councillor Bartley, please.
Thank you. Thank you for your report. I wanted to ask, well, we've got the chief economist here. Given the cost of living increases, more people will be struggling in our city. What are your thoughts around the austerity measures in the proposed budget that look to cut funding to our communities, funding that focuses on social well-being?
I haven't got a direct answer for that, I'm afraid. I've been looking at sort of focused on data around household incomes and cost of living pressures in terms of what households individually receive and their outgoings. So that question I probably would leave to others to answer in terms of the impacts of the proposed budget.
Okay, and then I wanted to pick up on your, one more question please, on the you mentioned the long run and how our competitive advantage would be the scalability to attract skills. Do you have any comments around how this will be impacted if one of our CCOs who's tasked with jobs and skills, attractions, attracting, developing skills that meet the market will take a severe hit in terms of that focus?
Thank you, Councillor. I would say my view on the long-term growth prospects of a city in large part is determined by some of the foundations, and those in my mind are land use policy, how we use our land, how we enable households and businesses to locate in efficient locations or locations of their preference, and secondly, how we invest in infrastructure to enable connectivity between households and businesses. So those are the fundamentals to me, and Auckland, you can make a case we've taken some real steps forward on both those fronts, and there's still a lot of work to be done there. And there are, I guess, other questions around what else can be done to attract skills and investment. But to me, the fundamentals are around land use and infrastructure investment, particularly in transport.
Interesting, thank you.
Councillor Hills, please.
Thank you, Mayor. Just a quick question on the debt, Peter. So we're getting to the point where we're nearly cash funding or grant funding or DC funding our capital, but there is about 320 or 312 that is on debt. So that's a choice, right? If we were wanting to, is it correct if we were wanting to fund that last portion in the last 6 months by cash, we'd have to put up the rates about another 13% to cover that?
That's a number of calculations on the fly, Councillor, which I'd struggle with without a calculator in front of me. We don't fully fund depreciation at the moment, as I think all council members know. We're at 75 or 80%. To fully fund depreciation, we'd need to increase rates by a proportion to do that. There might still be the need for debt funding, for growth, for other choices that council wishes to make. The use of debt is a choice that councillors are making at the moment because they're not fully funding depreciation, but it's still spent on assets. And the reason it's spent on assets is to spread the cost of that asset over the beneficiaries or the users of that asset over time. So it's an intergenerational equity issue. I couldn't answer the exact amount we'd have to increase rates by to be fully funding depreciation today.
Okay, but just thank you for that answer. So just to clarify though, if we weren't that 300 odd million, we'd either have to pull back or rate fund that last bit if we didn't want to add that to the debt at this stage.
I'm not really following the question, I'm afraid, Councillor Hills. I don't see how we could not spend debt over the next 4 months.
Yeah, I guess what I'm saying is that in the last annual budget, we made that decision to fund some of our capital work by debt. And if we didn't do that, we would have had to have either cut the debt or funded it through rates.
Thank you. I can grasp that question now. Thank you for the further explanation. Across the group, we're spending about 2.8 billion. If you take rates as 20 million or so per percentage point, you would be increasing your rates hugely.
Councillor Ferry, please.
Thank you. Picking up on Councillor Bartley's questions, I'm really interested in whether we're doing any analysis on the economic impact of proposed cuts to the community and arts sector and also to TAU. So as the chief economist, and this may actually be a question more for the CEO, but what advice will be coming to us on those to inform our decision making in the near future? Thank you.
Thank you, Councillor. If I can ask in brief, I have been asked by colleagues to assist with some thinking around, characterising the trade-offs around some of the decisions, and that also plays into a broader piece where I think the Planning Committee's asked for some report back in response to the severe weather events, and what part of that is also thinking about how do we identify the broader impacts of potential decisions that could be taken and how do we weigh up those trade-offs. So very much working with colleagues to think through about how we weigh up trade-offs so that we provide advice to you.
Thank you. Can I clarify what the timeframe might be on receiving some of that advice? Because we're receiving presentations from the community now, which are identifying some pretty big numbers. So, for example, in the film industry, and we will need to have some advice from council to weigh those those presentations up. So, what are we looking at in terms of a timeframe? Because we don't have that as yet.
I don't have the answer right now, but I'm sure colleagues will be able to come back to you on that soon.
And can I ask, please, and maybe this is something you need to come back on as well, what systems for measuring that kind of impact are you looking at? I'm aware of some, for example, that are used in the UK around measuring social impact, and so that it can be clearly articulated. It would be helpful to understand what systems and methods are being used to calculate those.
Just a brief response to your answer. Generally, from an economic perspective, we think about well-being for society, and that has some broad dimensions, often characterised at the local government level around economic, social, environmental and cultural. There are other frameworks too, particularly in central government, that provide a bit more detail about how we can think about those trade-offs in a qualitative sense. From an economic perspective, the way that we generally try and characterise the incremental impacts on wellbeing in terms of costs and benefits would be a cost-benefit analysis. Of course, that does require information and time.
Thank you.
Councillor Henderson.
Thank you, Mr. Mayor. I find it really fascinating how much we use the CPI index, which understandably obviously affects the households that we serve. But, you know, that basket of goods has capsicums and airfares in it and things that council don't buy. Have we considered looking at a measure, for example, construction related CPI, that might be more relevant to council's purposes and actually help us assess our own spending and debt? Thank you.
Thank you, Councillor. Yes, there are many indices that measure different baskets of prices through the economy. We do focus on consumer price index because that is a headline measure that is well understood, and it does inform some of the decision making around the official cash rate and interest rates, but there are other core measures of inflation. Alongside that, there is capital goods price indices, business price indices, construction cost indices as well. And so there are also indices at a local government level that some consultancies have prepared.
Right, can I leave that with Peter and Jim as well, to maybe for future reports look at what we can introduce into it, because that's pretty relevant stuff. Thank you.
That's a good question. I think you might find that it's even more gloomy. Construction failures are a good measure of difficulty, and you can see them on the rise. House sales activity is at the lowest level for a long time, and I would, in answering to help Councillor Ferries understand it, I might arrange a small presentation if we've got interested from Gravity Credit, who deal with the credit lines and pressures of households. The economic figures are very, very high level and don't actually get down into how it affects people that well. That's not a criticism of what you're saying, it's just the way it is, because you're measuring a global situation rather than a family-based interaction. So if you're interested, I can arrange that. We have a question from Wayne Walker.
Sure, just a couple of requests. One is that in our presentations we look back a few years in terms of our reporting, and that is particularly because one previous year is the COVID year, which is an absolute anomaly. And that especially goes to things like FTEs and so on. The other request that I have is as much and all as the reporting is of a very high level. It would be useful to know how we're performing in particular cost and revenue centres. For example, as the Mayor has pointed out, consenting activity is down. My understanding is that that activity from a revenue and expense perspective is meant to be somewhat self-balancing because we charge out. So how are we doing, and how does that sort of approach apply across those parts of the organisation where we could have some reporting around that? Otherwise, all we have is a notion that we're spending this much actual against budget, but really no idea as to how we're actually doing in particular areas. So welcome to respond. Thank you.
Councillor, thanks. I'll just note your question and request for now. Thank you.
Yeah, I keep a bit of a close eye on, in terms of the consent sector, which is largely cash neutral. We do have the ability to vary our costs down due to the fact that there has been use of consultants when they can close off. There's been a lot of criticism of consultants. There's consultants and consultants. We're using them as contractors to do work in a flexible demand area. You can turn them off a bit easier than staff. It's not a bad thing to do. So everything's not all bad just because it's got a name on the front. And the last question from me was on page 9 of the thing here. Direct revenue resources at 1.3 billion and direct expenditure at 1.7 billion. I mean, that's a $400 million gap, which is quite a big lump. You got a comment to make on that, or is that just how we're going for a bit?
Sorry, what's the reference page number? Where is that?
Matua, number 5 on page 9. Item 5 there, it says direct revenue sources for the group were $25 million higher at 1.3 billion, and direct expenditure was on budget at 1.7 billion. So the budget for the group is a $400 million loss over that period, which I suppose compared to what amount of debt that we think is not unrealistic. I just find odd things by reading everything. The other odd thing I found in there was under the item 8, something or other there, A, attachments. Auckland International in the 31st of December 21 made the princely sum of 7.39 cents per share, which is not a huge amount, and it dropped to 0.33 cents per share at the 31st of December. So less than a cent per share. I don't know why the hell people want to buy those at $6 or $7, but still, who knows? Madness is out there everywhere.
Thank you. I think you're in the next item 8. So if we could hold that
That's
question
probably true,
for
but
then.
I mean, it's all part of the thing. So we'll move on to, we're on to the overall thing. I'm sorry.
No,
I'll duck back and I propose to move and second the receipt of your information provided up to date. Moved and seconded by people. In favour? Contrary? Thank you. And it was it's good to get these updates, I've got to say. And I did wander into the next one, but it's kind of relative. Off you go.